Welcome to the Economist in Your Ear podcast. In today's complex economic landscape, when our central bank considers making a move, how do they really know if the economy is cooling down, heating up, or maybe just shifting beneath their feet, especially when political currents are swirling all around them? The Federal Reserve recently cut interest rates, and it's sparked this huge debate. Is this a prudent, risk management move, or is it a dangerous gamble that could loosen monetary policy just a bit too much? We're going to dive into a recent article from The Economist that cautions pretty strongly against over-easing.
Yeah, and it's a good piece. It raises some very valid concerns, absolutely. But I think we want to maybe peel back the layers a bit today, go beyond just the surface arguments in the article. We should explore a more nuanced view, drawing on, the latest data we have, and maybe some contrasting perspectives, just to help you understand the full picture of where America's monetary policy is right now. It's definitely not as straightforward as it might seem sometimes. And look, for you, being well informed on this means understanding not just what's happening, but crucially why it matters for, say, your investments and your wallet.
Okay, yeah, let's unpack this then. The immediate action we're talking about is the Fed's recent 25 basis point rate cut. Now, remember, a basis point is just 1/100th of a percentage point. So we're talking 1/4% cut. That brings the target rate range down to 4.00 to 4.25%. And a striking detail here, I thought, was that this wasn't presented as just a one-off move. There was a pretty clear signal for potential further cuts down the line. Plus, we even saw Governor Stephen Barron notably dissent. He actually pushed for an even larger 50 basis point cut, which definitely caught some attention.
Right. And a really critical element here, which the article smartly highlights, is how politics seem to be clouding central bank independence right now. I mean, it's not just an abstract idea anymore, is it? We saw, for instance, President Trump's attempt to remove Governor Lisa Cook. That was only blocked by a federal appeals court, remember? And then just days before this critical meeting, you had the confirmation of White House economist Stephen Barron to the board. These aren't just, minor footnotes. These are real institutional stressors. They really complicate the Fed's ability to act purely on economic data. Any decision they make, acting or not acting, could easily be seen through a political lens. And that makes their mandate of just maintaining price stability far more challenging, I think, because of these external pressures.
Mm-hmm. And The Economist's main economic argument for easing up on policy, it almost entirely hinges on one thing, doesn't it? The labor market. They've been pointing to this reported slowdown. Average monthly job gains only at 27,000 since May. That's a really sharp drop from what was at 123,000 earlier in the year. So, yeah, if you just look at those headline numbers, it does look like a weakening economy that might need a bit of a boost.
Exactly. But here's where The Economist presents its core counter-narrative. The piece suggests this weak jobs growth is primarily due to low migration, so the labor supply is shrinking, rather than a cold economy, which would imply softening demand for workers. They cite this figure, 8,000 encounters at the southern border in July, as evidence of collapsed immigration. And they note that a 4.3% unemployment rate is, quote, hardly evidence of a glut of workers. So their implication is fewer people are available to fill jobs. It's not that there are fewer jobs available, and therefore the economy doesn't need as much easing. It's a supply issue, not demand.
Right. And to sort of broaden that view beyond just jobs, the article brings in other economic indicators. It talks about strong retail sales, positive sentiment in the service sector, and what they call a euphoric Wall Street, which, you can see why. We're seeing soaring stock markets, really tight credit spreads. That's the difference in yield between very safe and maybe riskier bonds. Suggests investors feel pretty confident right now. And even a booming cryptocurrency market. All of this, they argue, suggests the rest of the economy shows, quote, no sign of flagging. It's almost like describing two different economies, isn't it? A weak labor market and then booming everything else.
It does create that impression. And this raises an important question then about inflation. The article notes inflation is at 2.6%, using the Fed's preferred measure, the PCE index. And it points out it's actually rising, partly due to tariffs. However, it kind of frames this effect as temporary because, as the article puts it, tariffs won't rise forever. Okay, but if we connect this back to those political pressures we mentioned, the article subtly suggests that a more politicized Fed might find it much harder to just ignore these kinds of one-time shocks to prices. Any decision, or even lack of decision, on how to respond to tariff-driven inflation could easily be perceived as taking a political stance, which further complicates their balancing act.
Okay, so The Economist basically wraps this whole argument up with a pretty stark warning. Loosening monetary policy too much now risks a really difficult reversal later on. Especially, they point out, if the central bank found itself having to hike rates sharply under renewed political pressure down the road. They essentially say, look, one cut might be insurance, okay, but going further is a mistake the Fed cannot afford. It's a very strong stance against what they see as potentially premature easing. Their core message seems to be, beware of loosening when the problem might be supply, not demand, and especially when politics are already muddying the waters.
Right. Now, let's maybe turn our investigative lens on those claims. Because while The Economist provides a compelling narrative, its framing might be a bit too one-sided or certainly needs some additional context in a few key areas. Let's start with that central supply, not demand argument for the labor market. That seems crucial.
Yeah, the article is clearly right that immigration has indeed fallen. That part's true. We've seen data showing the foreign-born population shrinking by over 1 million by mid-2025 and border encounters hitting historical lows. So the direction of declining immigration. Absolutely right. However, and this is where the numbers get a little tricky, the article cites 8,000 encounters at the southern border in July. But if you actually dig into the official releases from U.S. Customs and Border Protection, well, those show roughly 4,600 southwest border apprehensions by the USBP versus about 24,600 total nationwide encounters for that same month. It's a bit like looking at one specific puzzle piece and thinking you see the whole picture, While the overall trend of collapsing immigration seems accurate, the precise figure really depends on which category you're using. And that nuance kind of matters when you're using migration data to explain such broad macro trends like the entire job market.
Exactly. And crucially, we need to bring in the demand side here. We have to emphasize that demand signals have also softened. It's not just about supply. We've seen preliminary payroll revisions suggesting a much weaker jobs engine than we previously thought. Some early benchmarks show potentially huge downward adjustments to earlier payroll figures, meaning past job growth might have been significantly overstated.
Wow, okay.
Yeah. And the unemployment rate has ticked up to 4.3%. Quits, that's the number of people voluntarily leaving jobs, a key confidence indicator, they're back down to 2.0%. Manufacturing production, measured by the ISM index, is now sub 50, which indicates contraction. And housing starts have fallen pretty sharply, too. These are all classic demand-side cooling signs. You can't really ignore them. So I think the bottom line here is that both supply and demand are clearly at work, making the economist's supply, not demand argument perhaps a bit too simplistic. The key takeaway for you here is that the labor market isn't just suffering from fewer workers arriving. It's also seeing less demand for those workers.
Okay, that makes sense. It's both. Let's move on then to the economists' claim that markets prove policy isn't tight. And it's true, if you look at financial conditions, they do look pretty loose right now. The Chicago Fed's Index, the NFCI, National Financial Conditions Index, which gives us this comprehensive look at how tight or loose money is. Well, it's deeply negative, which means conditions are looser than average, and we see these high-yield and investment-grade credit spreads, the OAS, option-adjusted spreads, they're near cycle tights. So from that perspective, yeah, it does make it harder to argue that policy is currently super tight.
Sure, but saying markets prove policy isn't tight might be stretching it. It's not quite airtight.
Yeah.
What's important to remember here is that these risk asset booms, like the one we're seeing in stocks, they can reflect expected future growth, maybe optimism around AI, or anticipated falling rate paths just as much as they reflect the current policy stance.
Ah, right. Expectations matter.
Exactly. And while valuations are definitely elevated, the S&P 500's forward PE ratio is around 23. They are still below the peaks we saw during the dot-com bubble. So saying they're comparable to dot-com levels, as some might, is probably an overstatement. Now look, tight credit spreads do reduce overall restrictiveness even if the actual policy rate itself is above what we think is neutral. That's fair. But market euphoria isn't a direct, perfect read on policy tightness itself. It's a bit like looking at a super excited crowd at a concert and assuming everyone loves the opening act when maybe they're just pumped for the headliner later.
Got it. Okay, then there's the economist's argument that tariff inflation is temporary. We've certainly heard recent inflation reports noting clear pass-through from tariffed goods. Headline PCE, personal consumption expenditures, is hovering around 2.6% year over year. And core PCE, which strips out food and energy, is near 2.9% year over year. So the impact is definitely visible in the numbers.
But this raises a really important question. Can we truly just treat tariffs as a simple one-off price level shift, like a blip? The counterargument, and frankly I think a more realistic one, is that tariffs can ratchet and ripple through the economy in ways that aren't so temporary. We've seen reports of firms reacting by restocking inventory, suppliers repricing their goods more broadly, and there's even the risk of second-round effects, like wage demands increasing to compensate for higher costs.
Right, the knock-on effects.
Exactly. Recent reporting actually shows tariff-linked categories firming up in price indexes. And ports data suggests some companies are front-loading imports, trying to dodge future uncertainty. That tells you that many firms might actually expect these effects to be more persistent. So simply waving it away as a one-off price level shift might significantly understate its potential persistence and its impact on your purchasing power over time.
Okay, this is getting complicated. Let's try to cut through some of the noise now. Let's sift through the absolute freshest data available to us right now. What is the economy truly communicating based on the core numbers we have today?
Okay, let's break it down. On the labor market, what the numbers actually say is that average monthly job gains were indeed very soft over the summer. Confirmed. Those preliminary benchmark revisions we mentioned imply earlier payroll numbers were actually overstated, meaning fewer jobs were created than we first thought. That's significant.
Yeah.
The unemployment rate is 4.3%. Labor force participation is pretty much flat, and quits are low. So the picture there very clearly points to a cooling labor market. No real debate there. Okay, regarding the growth mix. Services is still expanding. The ISM Services Index is at 52, new orders at 56, that's decent. Retail sales rose 0.6% month over month in August, which is solid. However, manufacturing output is sub 50 on its ISM index that signals contraction, and housing starts slid 7%. So the picture is kind of okay services plus soggy goods and housing. A bit of a split.
A two-speed economy almost.
Kind of, yeah. Now on financial conditions. The latest data confirms they are looser than average, according to that NFCI index. High-yield option-adjusted spreads, OAS, are around 2.8%, investment-grade spreads near multi-decade tights. This means overall financial conditions are quite easy right now, arguably too easy, given some of the other signals we're seeing. And finally, for inflation, headline PCE is around 2.6% year over year, core PCE is about 2.9%, and the Dallas Fed's trimmed mean 12-month PCE, which tries to filter out noise, is roughly 2.65%. And importantly, it's noted that it's edging up in part from tariffs. So that impact is confirmed in the data.
Okay, so putting all that together, this fuller, much more nuanced picture, what does it actually mean for how we should think about the Fed's policy path from here? What are the implications for you, the listener, as you watch these headlines unfold in the coming months?
Well, first, that initial cut is insurance. It makes a lot of sense in this context. The labor market is undeniably slowing down. Those benchmark revisions confirm it's weaker than it looked even a few months ago. This aligns pretty well with Chair Powell's risk management framing, right? A proactive move to guard against a worse downturn rather than waiting until it's clearly too late.
Okay, so the first cut seems justified by the data.
I think so. However, embarking on a fast-cutting cycle from here would undoubtedly be a gamble. Why? Because financial conditions are already loose, as we just said. Tariffs pose a real risk of stickier inflation than maybe some people expect. And that whole issue of politicization, well, it raises the cost of any future U-turns, like having to suddenly hike rates again into an already hot political environment. That would be tough.
Yeah, very difficult.
This leads us to a really crucial, almost philosophical question for the Fed. Where's neutral? We're talking about RISTAR, the natural real rate of interest. That's the theoretical rate consistent with steady growth and stable inflation. It neither stimulates nor restricts the economy. The problem is, estimates for RISTAR range really widely. The Cleveland Fed's model puts it near 1.5%. But you hear arguments, like in some New York Fed speeches, that the low R-star era isn't actually over, suggesting it's closer to maybe 0.5%. That's a huge difference.
That's a massive range. How does that compare to now?
Well, with current headline PCE inflation around 2.6%, today's real policy rate, that's the 4.25% policy rate minus 2.6% inflation, is roughly 1.4% to 1.65%. So depending on your estimate of RISTAR, this suggests we're probably somewhere around neutral to maybe mildly restrictive already. Therefore, the bar for multiple further cuts should probably be fairly high, at least until inflation truly settles cleanly and consistently back at the Fed's 2% target.
Okay, so let's try and summarize our findings from this deeper examination. The economist is absolutely correct to raise a red flag about the risks of over-easing. That seems clear. And also about the dangers that political pressure can pose to the Fed's independence and its core mission.
Definitely. However, the article's central argument that weak jobs equals immigration collapse, not soft demand. Well, that feels quite overstated once you really dig into all the available data. The fuller picture clearly shows both things happening. Labor supply hits due to reduced immigration and significant demand cooling across various sectors. It's not really an either-or situation. It seems to be a confluence of factors hitting at once.
Right. So given the already loose financial conditions we just discussed, and those persistent and maybe underappreciated risks from tariffs, the safest path forward for the Fed, it seems to us, is probably gradualism. It's about taking measured steps, right? Not making big, sudden moves.
Exactly. This means, okay, one insurance cut now, which we've seen. That's done. Followed by a truly data-dependent pause. Let's see how things evolve. If unemployment continues to drift up significantly, and if core inflation measures genuinely ebb convincingly towards 2%, then, okay, cut again. But if financial conditions start running even hotter than they are now, or if that tariff-linked inflation really sticks around and proves persistent, then the Fed should absolutely stop cutting, hold the line. This kind of measured approach avoids unnecessary heroics and removes the dangers of just putting policy on autopilot.
Which leaves us, and you, with a key question to ponder. How much confidence do you have that the Fed can actually navigate these really complex, often conflicting economic signals while simultaneously warding off all these political pressures to ultimately make the right call for the economy? It's a huge challenge.
It certainly is.
Thanks for listening. Follow us for daily insights into world affairs, and don't forget to like, comment, and share.